fueled great growth in the industry, but they all became way overextended and eventually led to a lot of the crash. But fundamentally, having a customer that could benefit from your product, in our case with GuestAct, having Fairmont or Marriott pay us up front so we could get the installation in early. At that time, you could sell high-speed internet access for anywhere from $9.95 to $19.95 per room, actually per person per room. They wanted to get it in, they wanted to get revenue generated, so they actually helped fund it. VCs, private equity, there are private equity funds out there that will do investing, typically not startup investing, but I am starting to see some signs of private equity groups having some startup funds being spun off. And then banks and government. And if you can get the banks to loan you money, then you're a far better person than us. But there are cases where the banks will loan you money. It's just, you have to have a great track record. You typically have to have a lot of collateral, which isn't often common in the startup. So let's talk about some of those sources of capital, align them with some of the stages of development. And this is where, for those of you that were in Jim Clifton's discussion, he talked an awful lot about the lean startup movement and the different stages of development. So I tried to tie that in here. And then in the middle, suggest what the sort of common parameters for investment levels would be. So if you're early stage, if you're still trying to figure out who your customer is, so you're in that customer discovery mode that Steve Blank talks about, your pre-product market fit, certainly pre-revenue, you're still just iterating, trying to figure out what you're going to do and what this thing's really all about. You're really at the seed stage. Hard to raise anything more than $250,000 on an idea. I've seen it done. Certainly if you've got a history of success, particularly with certain investors, they will often fund people at the seed stage. But the most common investor at this level is going to be up here. So I created, you won't be able to see it down there unless I expand it. This is sort of my homage to Dave McClure, for those of you that follow 500 Hats for Dave McClure. The one thing he's known for is having really ugly graphics. So I put one in. Bootstrapping, yeah. Maybe a high net worth individual if you can find one. Apply for the accelerators. The first stage of investment is really going to come from those people you have some kind of influence over, in my way. If you could get some traction in the market, if you can prove out your business model, if you can actually generate some revenue or demonstrate demand. Somebody, you've gone from an alpha to a beta and somebody says, when can I actually buy this? When can I license your product? That kind of traction justifies increased levels of investment if it's needed. Caution, if it's needed. And with that will come more professional investors, angels, those strategic investors that we talked about, certainly the super angels that we're seeing, and maybe even some of the smaller VCs. So if you're looking at, I need $100,000, I need $500,000, I need $1 million to get to the next stage. If you're looking at that sort of middle group, in my mind, the angels, strategic investors, and maybe the VCs for fundraising. All right, you've taken off, you're generating revenue, profitability is in sight. First of all, if profitability is in sight, you got to ask yourself, why do I need more money? And usually the only really good answers are to dominate the market, to sew it up before the competitors can react, or if it's a very large market, it's to just accelerate our growth and that trajectory. And I will tell you, if you can get to that point, there's an awful lot of different types of investors that will come to the table. Certainly VCs are there, but that's when you can start to see private equity. You may be able to see mezzanine financing or debt financing if you can show that you can can address some of the covenants that traditional debt types of investors want to see, which is some kind of coverage of their investment. So if you've got enough of a track record that says, we've had 3 quarters of growing profitability, and we're putting this much to the bottom line, and we've got a pipeline of this much, and we can show that that will translate into this, you may be able to get banks or other debt-based investors. So we were saying with equity, certainly the VCs, this is their sweet spot. They're really happy to start investing if you're getting the $2 to $5 million revenue level and maybe putting 10 to 20% to the bottom line. That's sort of the sweet spot for the VCs. And when we're talking VCs, I'm not necessarily talking about the Kleiner Perkins that are looking at the next Facebook, although they'd be happy to find the next Facebook. I'm talking about your small regional VCs that might have a fund of $50 to $200 million and are prepared to put out $5 or $10 million to get you from $5 million in revenue to $50 million. So that's that sort of stuff. And then the last one is, once you become a category killer, the only way for you to grow is to either take over other businesses or expand your line of business into other businesses. Then the doors are wide open. And there's lots of people that will come writing you checks for those kinds of transactions. If you want to go public, there's a whole plethora of folks out there that do nothing but sort of hang in the wings waiting for somebody to have a great success story, and they will take you public. And they will shower you with private jet trips, with all kinds of things. They'll put you in front of a lot of investors. They'll promise you a lot of money, and they take their money off the top, and you may or may not see any of it. We can talk about public IPOs another time. So anyway, to me, that's sort of the matchmaking stage for all this. I'd have one last sort of Canadian sort of icon. For those of you that follow hockey, that's the Calgary Flames. But I did want to talk a little bit about sort of what's hot right now, what I'm seeing out there. Business to consumer is hotter than ever. There was a time, certainly in the last decade, and I think the first half of this decade, where business to business still got the majority of the attention from investors. Enterprise sales, cloud computing, hardware. B2C is hot. It's a hot, hot ticket. We've all got the social network to thank. Everybody should, when they leave here, thank Zuckerberg for opening that up, because it's a hot one. Super angels, the group I was talking about a couple of minutes ago, seem to be in vogue. They seem to be able to raise money, which is good, because the fund has to have money in it in order for them to invest in you. What's interesting to me is they do deals quicker. Go follow Dave McClure if you have the stomach for foul language. It's entertaining for a while and it's off-putting once in a while, but one thing you'll find, whenever he goes to a city, pretty much, if you see he's going to a new city, offer to pick him up at the airport. He does deals in the cab or the ride from wherever he's just been to where he's going. He does deals. He's doing 10 to 20 a month, it seems right. So these super angels are hot. Now, there's only pockets of them. They're certainly in Southern California. We're starting to see some in Boston. Other than that, but you know what? I've got it further down. They travel. The amazing thing to me is in the past, you had to always go to the VC. And very often, the VC had a 60-mile rule that said they wouldn't invest in ventures that were more than 60 miles away. If you were more than 60 miles away, they actually had a solution. You move here. pick the 2 or 3 or 5 people that are most important. Pick them up. We'll find a hovel for you here, and you can be closer to us. We're writing the check. You stay here. Now the investors are traveling. And they're traveling not only to you, but they will travel to events. And you can seek them out at events. Web 2.0 was a couple of weeks ago. Dave McClure's writing deals at Web 2.0. Seed is the new Series A. It used to be that everybody celebrated Series A rounds. Seed funding is what everybody's all excited about. And one of the reasons for that is many companies, if they can get their seed round in place, it's all they ever need, or it's certainly all they need to get to show traction in the marketplace. And once you've got the traction in the marketplace, you've got customers telling you that what you've got is worthwhile, it's a lot easier to raise additional funds. Another one that's not nearly as glamorous or exciting to talk about, but standardized documents is a boon for all of us. It used to be all of the VCs had all of their own documentation. You had to hire a very expensive lawyer to comb through it, understand what they were doing, try to talk them out of many of the clauses that were hugely punitive or detrimental to you. But again, part of the transparency of the web today, and I think maybe this new generation of investor who says, let's invest on reasonable terms, they become much more transparent. So at the end, I've got a couple of sites where you can find standard seed series documents. And if an investor isn't prepared to use one of those, one of the questions should be, why not? You know, if it's good enough for Brad Feld, or if it's good enough for, you start dropping names, why, for Paul Graham, why isn't it good enough for you? And then another one that's sort of come out of the woodwork that I have mixed feelings about is this concept of continuous investments, which says we're not going to do a specific round, which tends to mean immediate equity, but we're going to do convertible debentures or some other kind of debt structure that has a conversion to equity down the road, which means you typically can ask for money and take debt in any time without issuing shares. So you don't trigger a change in your capitalization table. It doesn't affect your articles of incorporation or all the things that are affected by having certain numbers of shareholders or shareholders with certain privileges. The downside with that, in my mind, is that one, I don't think you've got a common currency between you and your investors, and I don't think that always makes sense. And also, most of the convertible debentures that I'm seeing out there right now come with a specific cap. So while they say we don't have to set the price now, we're going to limit it anyway. And if you limit what the conversion is going to be down the road, you've in essence already set the price. So if you're going to do that, let's get everybody speaking the same language and using the same product. That's sort of what's hot. Anybody else see hot stuff? Venture fund? Okay. All right. A little bit of what's needed in order to get there. I guess a good idea goes without saying, but people don't fund ideas. And again, go read or watch the videos on venture hacks. Ideas are a dime a dozen. Don't even worry about protecting your idea. The key is to do something with the idea before you go and seek investment. What you do have to have, though, is you have to be involved. Pretty hard to have a absent founder from the transaction. You obviously have to have enthusiasm and passion in what you want to do. A couple other things, though. I was just looking at a couple of interviews with some of the investors, and they said they also look for things like an intense curiosity, as opposed to necessarily somebody that claims to know everything. Someone that has this sort of deep desire to learn more, to reach more. So ask yourself, is that you? And I think there needs to be some knowledge or domain expertise in what it is you're doing.